What if I told you that a piece of advice, often touted as essential for new business owners, could actually be costing you money? What if this widely accepted strategy is in reality a costly misconception? That forming an LLC, a limited liability company, while seemingly a smart move, might not be the financial game changer you expect, especially when it comes to your federal taxes. The go-to advice for new business owners, the suggestion that's almost always thrown around when starting a business, usually does nothing to lower your federal income tax bill. In fact, it might even complicate things without providing any tangible tax advantages. People rush to form LLCs, caught up in the excitement of launching their venture, thinking it's a tax hack, a secret weapon to minimize their tax burden and maximize their profits. But for most one-person startups, for those solo entrepreneurs pouring their heart and soul into their business, it's just an expensive myth. A costly misconception that drains their resources without delivering the promised benefits. The truth, the often overlooked reality that many fail to grasp. A standard LLC doesn't change your tax situation at all. It doesn't magically reduce your taxable income or unlock hidden deductions. You could be wasting hundreds throwing away hard-earned cash on something that provides no real tax advantage. Sometimes thousands on setup fees, legal consultations, and ongoing compliance costs. On fees for no tax benefit. Money down the drain simply because of a misunderstanding. So why does this myth persist? Why do so many people blindly follow this advice without questioning its validity? Today, we'll break down the real differences between a sole proprietorship, the simplest business structure, and an LLC, examining their legal and financial implications, and show you what actually matters for your taxes. We'll cut through the noise and focus on the factors that truly impact your tax liability. Forget the hype, ignore the misleading claims and the empty promises. Let's get to the real story. Let's uncover the facts and empower you to make informed decisions about your business structure and tax strategy. Let's clarify the basics before we dive deeper into the world of business structures and taxes. It's essential to understand the fundamental differences between a sole proprietorship and a limited liability company, or LLC, as these choices will impact your legal and financial obligations. We'll break down each entity, highlighting their key characteristics and how they're treated by the IRS. A sole proprietor is essentially anyone who starts a business without filing any formal paperwork with the state. It's the simplest business structure to establish, making it a popular choice for freelancers, independent contractors, and small business owners just starting out. You are the business, and the business is you. There are typically no fees to pay to get started and no complex forms to fill out. You simply begin offering your services or selling your products. It's just you and your business, operating under your own name or a chosen business name. This simplicity can be appealing, but it's crucial to understand the implications of this structure. An LLC, on the other hand, is a formal business structure that you actively pay the state to create. This involves filing articles of organization and adhering to certain state regulations. Its main benefit, and often the primary reason people choose this structure, is liability protection, not necessarily tax savings. This means your personal assets are typically shielded from business debts and lawsuits. Here's the catch, and it's a crucial one to understand. For federal tax purposes, the IRS treats a single-member LLC almost exactly like a sole proprietorship. This is a point of confusion for many new business owners. There are no special tax breaks automatically granted simply because you've formed an LLC. You won't be using any different forms than you would as a sole proprietor, at least not initially. Both sole proprietorships and single-member LLCs report their business income and expenses on Schedule C, profit or loss from business. This Schedule C is then attached to your personal tax return, Form 1040. The profit or loss from your business is ultimately included in your overall taxable income. The only real difference, at least from the IRS's perspective in this specific scenario, is the legal protection that the LLC structure provides. It's not about how much tax you pay, but rather about safeguarding your personal assets from potential business liabilities. So don't confuse legal structure with an automatic tax advantage. The tax benefits, if any, come from deductions and credits you claim, not simply from the business structure itself. This understanding is the foundation for everything else we'll cover regarding business taxes. Grasping this distinction between legal structure and tax treatment is absolutely crucial as we move forward. Here's how taxes really work for sole proprietors and single-member LLCs. You pay regular income tax on your net profit, just like a salary. But you also pay self-employment tax 15.3% on your first $177,500 of profit, then 2.9% above that. For example, $80,000 in profit means $12,240 in self-employment tax, plus income tax on the rest. The structure, LLC or sole proprietor, makes zero difference in this calculation. Both file Schedule C, both pay the same taxes. The IRS cares about your profit, not your business entity. The myth that LLCs unlock special tax deductions is just that, a myth. The IRS allows you to deduct ordinary and necessary business expenses no matter your structure. Sole proprietors and LLCs get the same deductions. Laptops, supplies, advertising, you name it. There's no secret list of LLC-only write-offs. The confusion comes from mixing up LLCs with more advanced tax strategies like S-Corp, which are a different story. If you're a freelancer making $60,000, your tax bill is identical as a sole proprietor or LLC. Don't pay extra for a tax break that doesn't exist. Let's tackle another common misconception that floats around in the small business world. It's a belief that can sound incredibly appealing at first glance, promising both financial control and significant tax savings. But like many things in the world of finance, the reality is a bit more nuanced than the initial pitch. This myth often starts with the simple act of forming an LLC, a limited liability company. The idea is that forming an LLC magically lets you pay yourself a small salary, minimizing your tax burden. The promise? To save a significant amount on self-employment tax, a considerable expense for many small business owners. But unfortunately, this isn't true for a standard LLC operating under the default tax classification. You simply can't pay yourself a W-2 salary, the kind employees receive directly from a standard LLC. This is because with a default LLC structure, the IRS views you and your business as one and the same for tax purposes. As a result, all profit generated by the business is considered your personal income, and is therefore subject to self-employment tax, which covers both Social Security and Medicare taxes. The salary and distribution strategy, where you take a portion of your earnings as a salary, and the rest as distributions, only becomes a viable option if your LLC actively elects to be taxed as an S-Corp or S-Corporation with the IRS. This election is a formal process with the IRS, changing how your business is viewed for tax purposes. As an S-Corp, you're then required to pay yourself a reasonable salary, similar to how a traditional employee would be paid. This salary is subject to standard payroll taxes including income tax, Social Security, and Medicare. The remaining profits can then be taken as distributions. These distributions are not subject to self-employment tax, potentially leading to significant tax savings. But this strategy only truly makes sense from a financial perspective if your business profit consistently exceeds $60,000 to $80,000 a year. This is because electing S-Corp status comes with extra costs. These include increased administrative burden and more complex paperwork. So if your potential tax savings don't outweigh those additional costs, you could end up losing money in the long run. Therefore, for most new businesses just starting out, implementing this strategy is often premature and can create unnecessary complexity. So don't fall for the salary myth unless you're truly ready to handle the added complexity and costs that come with S-Corp status. Make sure the numbers work in your favor before taking the plunge. Tax laws are changing. The Qualified Business Income, QBI deduction, up to 20% off your business income, still applies in 2025 for both sole proprietors and LLCs. But it's set to expire in 2026 and tax rates may rise. This doesn't change the LLC versus sole proprietor debate, but it does mean you should maximize deductions now and plan ahead. The self-employment tax rate is still 15.3% on the first $177,500 of profit. Don't get distracted by future changes. Your business structure doesn't affect your eligibility for these deductions. Focus on tracking income and expenses. That's where you control your tax bill. The fundamentals matter more than the headlines. Meet Alex and Ben, two freelance web developers. Both earned $70,000 in profit in 2025. Alex is a sole proprietor. Ben forms an LLC and pays $480 in fees. At tax time, both report $70,000 on Schedule C, both pay $9,893 in self-employment tax, and both have the same taxable income after deductions. The LLC gives Ben no tax savings, just extra costs. The only difference? Ben gets liability protection but pays more upfront. For most new businesses, the LLC is not a financial win. The myth is busted. The simplest path is often the most profitable. Don't pay for complexity you don't need. If taxes are the same, why form an LLC? Two reasons: liability protection and professionalism. An LLC shields your personal assets if your business is sued, unlike a sole proprietorship, where everything you own is at risk. For businesses with real risk, contracts, products, employees, this protection is worth the cost. The second reason: perception. LLC after your name signals credibility to clients and partners. Some contracts require it. The real difference isn't about taxes, it's about risk and reputation. Choose based on your business's needs, not tax myths. Here's your action plan. Start as a sole proprietor. Free, simple, and perfect for testing your idea. Track every dollar in and out. Good records are your best tax tool. When your business grows and risk increases, form an LLC for protection. If your profit consistently tops $60,000, $80,000, talk to an accountant about S-Corp status to save on self-employment tax. Don't jump into complexity before you need it. Upgrade your structure only when your business justifies it. That's how you build a profitable, protected business without falling for expensive myths.